In markets, history repeats quite often, which is why market patterns also tend to repeat quite often. Every market day is different, but it is similar to some prior day in history. By understanding different types of market days, you gain the power to predict reversals, breakouts, and stalled markets with remarkable accuracy. Trading is a game of identifying patterns that repeat, and ruthlessly executing your system consistently. Highly successful traders stick to either one or two setups, but they consistently execute these setups with big volume and make a killing in the market. The first step to finding your core setups is identifying the types of market days that repeat again and again. Once you can correctly recognize the type of market day that is developing, you can then decide which of your setups to deploy. In today's video, we'll discuss 5 types of market days that you see again and again in trading. Market day type 1. Trend day. This is the most aggressive type of day because market participants have strongest conviction about direction on this day. Market opens strongly and moves convincingly in one direction. It could be either bullish trend day or a bearish trend day. On a bullish trend day, market opens at day's low and closes near the day's high. Similarly, on a bearish trend day, market opens at day's high and closes near day's low. There might be some pullbacks in the market, but the overall conviction in direction is never called into question. Such types of market days happen 2 to 3 times a month, and if you can time these days accurately, they can make your whole month, sometimes even year, in terms of profit. On such days, it's easiest to make profit once you get the direction right. But it can also fool you into believing that trading is effortless and unchallenging, and you've found a way to easy money. Which is highly misleading. Market day type 2. Double distribution trend day. This day is similar to a trend day, but market's conviction in the direction is low. This type of day is characterized by its indecisive nature in the starting hours, creating a narrow initial balance. What's initial balance? Initial balance is the range covered by price in the first hour of the day. Initial balance high and initial balance low are the highest and the lowest prices reached in the first hour. The initial balance is quite important in identifying the type of trading day. A double distribution trend day starts off quietly, with the market trading in a tight range, creating a narrow initial balance, sort of like a warm-up. Then, suddenly, prices break free from this range and start moving strongly in a new direction. This gets traders either buying or selling with enthusiasm. Once the market reaches this new value, it takes a breath and forms another trading range before the day ends. The double distribution part comes from the fact that most of the day's trading activity is either at the start or end of the trading range. Market day type 3. Typical day. These are the most common types of market days, occurring frequently. This type of day is characterized by a wide initial balance that is created in the first trading hour, and price trades within that range for the remaining day. There might be a rally or decline at the start of the day triggered by traders cutting of their previous positions, which leads to a wide range in the starting hour of trading session or a wide initial balance. After the wide initial balance is formed, you will see that price stays within that initial balance for the remainder of the day. Sometimes, price breaks out of that range and moves sharply in one direction during the end of the trading session. Such days are referred to as expanded typical days. At this point, I'd like to request you to please take a moment to subscribe to this channel. It's free for you, but it gives me a lot of support and motivation. If you learned something of value from this video, please like this video. Thanks. Now let's move on. Market day type 4. Trading range day. Trading range day occurs when both buyers and sellers are actively auctioning price back and forth within the day's range, which is usually established by the day's initial balance. On this day, the initial balance is wide, similar to a typical day, but instead of quietly trading within the initial balance range, the price moves back and forth between the two extremes of initial balance. At the lowest point of initial balance, buyers become active and move the price up, till they reach the initial balance high, where sellers come into action, and the price falls back to the initial balance low. This cycle repeats throughout the day. Market day type 5. Sideways day. This is the quietest trading day of all. There is no directional conviction. Price stays in a very narrow range throughout the day. There is least amount of participation from the buyers and sellers. The price doesn't move back and forth like a trading range day. To say the least, the price almost remains stagnant, as most market participants refrain from trading. Such a day is characterized by a narrow initial balance, which remains unbroken for the remainder of the day. It is one of those days where you should stand aside and not get into unnecessary trades. You have to remember that not every trading day needs to be a trading day. Many traders believe that because they are traders, they must be in a trade at all times, which is a big mistake. You should only trade when the circumstances are the most favorable for a profitable outcome. If you want to learn more details about each of the market days, I highly recommend reading Frank Ochoa's book. I'll link to it in description. You can get it book from there. It's one of the best book for someone looking to become a professional trader. Please subscribe and like the video if you haven't already. Thanks for watching, and I'll see you in the next one.